Good afternoon and welcome to Prime Interest. I'm Perry Ann Boring.
And I'm Bob English.
And let's get to today's headlines.
Are the rats scampering off the sinking ship, the ship being the Fed? Governor Elizabeth Duke just wrote her own pink slip yesterday in a surprising turn of events. This is ahead of the expected departure of Chairman Bernanke, who will likely not seek a third term this January.
All while the media is busy floating Larry Summers as Bernanke's replacement. But let's not forget, he's the guy who helped tank the Harvard Endowment Fund, ignoring warnings from Iris Mack that it was loaded with toxic derivatives. So let's just put him in charge of the Fed's $3 trillion balance sheet.
And speaking of derivatives, today was a critical deadline where an exemption to Dodd-Frank was set to expire. The likes of JP Morgan have been able to trade in London and evade U.S. rules. We know how that worked out thanks to a certain City of London whale. But a turf war compromise has been reached between the U.S. and Europe. So don't worry, the $700 trillion derivatives juggernaut will continue unabated.
And could there finally be a Fannie-Freddie wind-down in the works? Congress has been debating it for a while, and House Republicans are pushing for a bill that would, quote, virtually remove the government from the housing market. Except it won't, because the replacement would be an insurance scheme similar to the current student loan scheme. And there's an additional sticking point. According to Bruce Crastings, a new shareholder lawsuit against the mortgage giants would make it difficult to exterminate the mortgage giants. Stay tuned, because Bob will talk control fraud with William Black, the guy who exposed corruption in Congress relating to the savings and loan scandal 2 decades ago.
And Perry Ann will present the new Ron Paul channel, coming to an internet near you this summer. We also have an interview with Chris Rossini from Economic Policy Journal and the Ron Paul Institute.
And here's what's in your prime interest.
The savings and loan crisis was one of the biggest financial scandals in U.S. history. At the time, 5 senators, known as the Keating Five, were accused of trying to prevent an investigation into Lincoln Savings and Loan Association. This was a loan bank, and the collapse of which cost taxpayers over $3 billion. I spoke earlier with William Black, associate professor at University of Missouri, Kansas City, about his interaction with the Keating Five.
Keating got 5 U.S. senators to meet with us and to ask us to take no enforcement action against the largest violation of our rules adopted as part of re-regulation in the history of our agency. And we said no, but then they got new head of the agency and they intimidated him, and he removed our jurisdiction. We were the regional regulators in California. He removed our jurisdiction over Lincoln Savings because we refused to withdraw our recommendation that the government take it over. And Lincoln Savings was allowed to grow and its frauds to increase, and it became the most expensive fraud in the savings and loan debacle. It also finally put a public face on the victims. Usually because of federal deposit insurance, you don't have an identifiable human victim of these frauds. It's all of us as taxpayers. But in the case of Charles Keating, he sold useless, worthless junk bonds of the holding company, which were not federally insured, and he targeted widows. So finally there was a face on the savings and loan debacle, and that face was your grandmother.
And we saw actually 1,000 bankers go to jail during that time. Why aren't we seeing that now? What is the problem? Too big to jail? Is that it?
No, that's not it at all, although that's the excuse for it. In the savings and loan debacle, I mentioned that the re-regulation began immediately after the Deregulation Act, and that re-regulation was run by the chairman of the regulatory agency. His name was Edwin Gray. And Gray also began the changes where he said, our top priority is to remove the frauds from control of the savings and loans, so to stop them from causing greater damage. And our second priority is to get them convicted. And so that began a process that took many years and resulted in superb criminal referrals. And criminal referrals are what are absolutely essential if the prosecutors are going to successfully prosecute a sophisticated financial fraud of this kind. Because, as you would probably figure, somebody running a bank, they're going to make sure that the bank doesn't make a criminal referral against them. So these criminal referrals can only come from the regulatory agencies, at least in any significant number. And our agency made over 30,000 criminal referrals. Now, the savings and loan debacle was 1/70th the size of the current crisis in the United States. And of course, that's not even talking about the crisis elsewhere in the world, which is also largely driven by control fraud. We convicted over 1,000 people, and that's just in cases designated as major by the FBI, and that understates the degree of prioritization, because we made a big effort to get the 100 worst fraud schemes. That was about 300 savings and loans and about 600 individuals. Virtually all of them were prosecuted, and we had a 90% conviction rate. And of course, white-collar criminals have the best defense lawyers in the world, and they'll spend money like water to stay out of prison. So that was an extraordinary success. But again, it all comes back to, has to begin with the criminal referrals. We'll flash forward to the current crisis.
Certainly. Let's flash forward to the current crisis. It was actually predicted as far back as 2000, and it has to do with an interesting angle that you've been writing about called appraisal fraud.
Right. So what happened in 2000 is that a significant number of honest appraisers, eventually the number became 11,000, over 11,000, drafted a petition and signed it and sent it to Washington, D.C., saying, hey, there is really widespread appraisal fraud, and the lenders are leading this appraisal fraud. And the way they're doing it is they're extorting appraisers. If you give an honest appraisal, you get blacklisted. And here's the kicker. The lenders want us to inflate the appraisal. In other words, the house is really worth $300,000. They want us to say that it's worth $380,000 so they can make a loan for $380,000 and charge additional fees. Well, you know, no honest lender would ever inflate an appraisal, because the property being pledged as security for the loan is what protects you from loss. So when you get a widespread appraisal fraud, you know, first, it has to come from the lenders, because they're the only ones that can do it. And second, you know, they must be covering up an underlying fraud. And that underlying fraud was something that we now call liar's loans. These are loans made without verifying the borrower's income. And we know from investigations that it was overwhelmingly lenders who put the lies in liar's loans. And what did they do? Again, it was a matter of inflating the borrower's income to make it look like they could actually afford the $380,000 home loan that I had just gave you as an example. So these are integrated frauds. You can think of them as a twin barrel assault from a shotgun, where there's overlapping field of fire between the two barrels.
That sounds pretty dire. Let's talk about all these settlements that the banks have been making with the government and states attorneys general. They have a number of reps and warranties problems that stem from the origination of these liar's loans. How much fraud is still embedded in the system, and how do we get it out, if at all?
Well, that's where we bring back this story together. You asked me about how many criminal referrals were made in the savings and loan crisis. I told you over 30,000. I told you this crisis is at least 70 times larger and has vastly more fraud than in the savings and loan crisis. The same agency that I worked for, the Office of Thrift Supervision, which had jurisdiction over some of the worst fraudulent lenders like Countrywide, made 0 criminal referrals in this crisis. The Office of the Comptroller of the Currency, which is supposed to regulate the largest banks in America, made 0 criminal referrals. We know of no criminal referrals by the Federal Reserve. The FDIC is smart enough to refuse to answer the question.
That was my interview with William Black, Associate Professor at the University of Missouri, Kansas City. And now we turn to the former U.S. Congressman and presidential nominee, Dr. Ron Paul. He recently announced that he is launching the Ron Paul channel this summer. The network will be broadcast exclusively over the internet and focused on his message of peace and prosperity. Perry Ann Boring has more.
Representative Ron Paul retired from Congress last year after an 8-term stint. But the 78-year-old has not retired from what he calls the revolution. And he just announced he will be launching the Ron Paul channel this summer.
But he's not finished. He's looking for a way to contribute, to continue to advance the ball down the field. And this is certainly a good way for him to do that. I wouldn't expect him to just retire on a rocking chair out there on a porch in Texas.
Dr. Paul ran for president twice. In his last election, he felt he didn't get fair media coverage. Peter Schiff agrees.
I think had he had gotten a fair shake, he'd have won Iowa early. He'd have won New Hampshire. He would have had a lot of momentum. He might have actually been our nominee. And I think if Ron Paul had been a Republican nominee, he wouldn't be retired now doing the Ron Paul channel, because I think he could have beaten Barack Obama and he would now be the president of the United States. So, the media, though, didn't want that to happen.
His colleague Tom Woods from the Mises Institute said when Ron Paul left the campaign, he was discouraged and ticked off at the media.
When it comes to the media refusing to allow people to hear the full spectrum of opinion that exists, well, yeah, that does actually tick him off. And frankly, I find it encouraging to see him ticked off. He should be.
Soon after the campaign, Ron Paul resigned from Congress and started the Ron Paul Institute for Peace and Prosperity. Daniel McAdams is the executive director of the Institute.
The mission is to carry on and to accelerate what Congressman Paul was doing through his years in Congress, and before that, working for a non-interventionist foreign policy, working for reduction in our military spending, reduction in the empire, and also protection of civil liberties at home.
It's here that he is challenging the establishment.
Ideas are very radical things too, and educating people and informing them about things that they've not been exposed to. It can be a very radical thing, and it can be an enlightening thing as well.
During his time in Congress, he spoke out against all foreign aid, and that would include Egypt. He recently wrote that, despite the Egyptian government being overthrown by a military coup, the Obama administration will not utter the word coup because acknowledging reality would mean an end to U.S. assistance to the Egyptian government and military. He also went on a rant to warn Americans of the E-Verify program that's tucked in the immigration reform bill. The National ID Mandatory E-Verify database will not only be used to prevent illegal immigrants from gaining employment, instead it will eventually be used as another tool to monitor and control the American people. Since the mainstream media has never been his ally, Ron Paul is taking matters into his own hands. Turn off your TV, turn on the truth. Perry Ann Boring, RT. The future to consume media is moving online, and Dr. Paul is headed in that direction. The Ron Paul channel could bring endless possibilities to his message of liberty. And coming up next, Chris Rossini from the Ron Paul Institute and Economic Policy Journal is here to discuss business cycle theory. Then Bob heads to the Daily Duel with RT correspondent Liz Wall over Apple's antitrust price-fixing lawsuit.
I would rather ask questions to people in positions of power instead of speaking on their behalf. And that's why you can find my show, Larry King Now, right here on RT. Question more.
Looking for celebrity gossip and the feel-good fluff? You won't find it here. But if you're looking for relevant stories, unique perspectives, and tough questions, tune into RT.
There's been a lot of talk about bubbles lately and the boom-bust cycle. Where does it come from? The Fed, maybe? Here to present the Austrian side, that would be the Austrian business cycle theory, is Chris Rossini. He's a columnist at economicpolicyjournal.com and the Ron Paul Institute. I talked to him earlier and began by asking him about the causes of the boom part of the cycle.
The boom is actually where the damage is done in the business cycle. A lot of people, the focus is on the crisis afterwards, but the boom is where the damage occurs. And that's where the Federal Reserve pushes down interest rates artificially by printing money, buying up bonds, and injecting money into the economy. And it gives a false impression to businesses that savings have increased and that people have decided to withhold consumption. But that's not the case. If we were living in a market, the interest rate would be higher in a free market. But the Fed instead distorts the picture by pushing down interest rates, and it stimulates all loans, all these loans that really should not occur. And we saw it in the dot-com bubble, where companies without revenues and barely any business plans were receiving money hand over fist. We saw it in a housing boom, where houses, skyscrapers, neighborhoods were all built, shopping centers were all built, and they should not have been built, and now they're sitting empty in many places throughout the country. So the Fed only creates damage, but they get away with it because during the boom, it actually appears like wealth is being created, and it's called a wealth effect. And people see their stock prices go up, they see housing prices go up, double, triple, quadruple, and it feels like real wealth is being created, but it's not. What they have done is distorted the economy, and the damage is revealed when they start raising interest rates later on.
Well, let me play devil's advocate here. I kind of know your position on this, but Paul Krugman, he says that aggregate demand is what counts. And we had Keynes, who actually helped invent GDP, gross domestic product, in the mid-40s. He was a big proponent of aggregate demand. Why shouldn't we just look at that as a solution?
To tell you the truth, aggregate demand it ignores the other side of the cycle, which is supply. And what builds wealth in society is an abundance of capital goods, products that people can consume and enjoy and find utility in. So to focus only on demand and to think that to create money out of thin air, or to hand out all these stimuluses, whether it be, even there's some people suggesting that the government should start handing out straight to people. They should just write checks to people. Now, this is a total fallacy in that this can bring about wealth. Wealth cannot come from a printing press. Wealth comes from hard work, creation, entrepreneurship, and savings, people then restricting some of their spending, not spending every dollar that they have and more, and then with those savings, providing funding for new ventures and for businesses to expand.
Okay, so we talked about the boom part of this cycle. Let's talk about the bust. Can you walk us through that, exactly what happens when the Fed has to rein in monetary policy?
Yes, the Fed eventually, this is after, and it could last a long time. We saw throughout 2000 with the stock market and the housing, lasted for a while. Ultimately, because consumers have not decided to save and withhold consumption, it means they're consuming, and the businesses are investing at the same time. So everybody is spending at once, and it's craziness. And ultimately, that ends up pushing up prices.
Well,
Fed...
Yeah, I'm sorry. Go ahead.
The Fed begins to worry. They supposedly are worried about inflation, and they're supposedly there to keep inflation down when, in truth, they're the only source of inflation. So once they see prices get out of hand in their own minds, they begin to taper back start creating less money, buying less bonds. And what happens is all the malinvestments that were made during the boom are now exposed.
Let me ask you, what is in store for the future of the U.S., given what you've just talked about? What is your projection of what's going to happen when the Fed finally does end this QE policy? And would they have to restart it again at some time in the future?
That seems to be the trend. They seem to blow up bubbles and then pop them and then blow them up again. And they have plenty of support in media and writers that say that the cure is to do it all again. That's the only cure. When what's happening is the market is trying to cure itself. All the malinvestments have been exposed. Unfortunately, people have to be laid off. Unfortunately, houses have to remain empty until they come down to their market price. Unfortunately, businesses have to close. We saw plenty of .coms go under. They should have never been started to begin with, but they had to go under. And that's basically the market saying, hey, let's get back to reality. The Federal Reserve distorted the market, and the market tries to bring back reality.
That was my interview with Chris Rossini, columnist with economicpolicyjournal.com and the Ron Paul Institute. Joining me is Liz Wall, RT correspondent. Thank you for joining me today, Liz.
Great to be here, Bob.
All right, let's just jump into our first story. Just this week, a federal judge ruled that Apple played a role in conspiring to set ebook prices. Apple was accused of working with 5 major publishers in an attempt to force Amazon.com, a major ebook seller, to change its pricing model. So, I give the floor to you.
All right, Bob. Well, I know you. I know your kind of school of thought there, and I know you love that free market. And I'm not saying, definitely not saying that's a bad thing, but I think in this case, the judge was trying to find out whether or not in this case, Apple broke the law. And what the judge found was that, yeah, when Apple worked with these other companies to fix prices, that they took it a step too far and did violate the law.
Well, here's the problem with the law: is it's completely arbitrary. What Apple did is it conspired, you can use that word, but it met with a bunch of publishers and it said, we want exclusive rights to your material. And yes, they set prices, they were able to raise prices in the market, but Apple took a gamble. This could have failed. Apple could have lost a lot of money, and it's really up to the consumers to decide whether or not they're going to buy a particular product. The problem with the Department of Justice going after these kinds of cases is they can go after it in a very arbitrary way.
Yeah, and certainly that we're waiting to see what the effects of this are going to be. But you have to remember, Bob, that these laws were put into place for a reason back in the late 1800s, in the days of Rockefeller, when he was being scrutinized for unfairly pushing the competition out. And
we had the robber barons, but let me tell you about the real reason we got these laws. And they were actually based off of state antitrust laws. And I think the model in particular was used by Missouri. And the reason was there were a bunch of cattle farmers and hog farmers who were upset that all the business was being done more efficiently in Chicago. So they got a state law passed, an antitrust law, to push these guys out and to artificially set prices based on this supposed antitrust scheme. And when the U.S. came up and they wanted an antitrust law, they adopted that. So it really has nothing to do with what you're saying, I'm afraid.
You don't think so?
No.
Well, I don't know. I can only speak from the standpoint of what was, from back then and why these laws were implemented. Things like the Sherman Act 1980, saying that, when there's trying to prevent these monopolies from happening, and so that there is a fair environment, so a free market can happen, and so that the market isn't just one monopoly, and that there are able to be multiple participants. And in this case, it's not even, they're not even saying it's against the law to have a monopoly, but even if there is a big company that is running very successful and grabbing a big share of the market, that there are some regulations and there are some limitations set in place. At least there are some rules to make sure that there is a fair game, and these are the laws that are in place, at least at this point.
Well, let's talk about Microsoft, because over a decade ago, the Justice Department launched an antitrust suit against Microsoft. It cost them them hundreds of millions of dollars. And unfortunately, that marked a turning point in Microsoft's. And from there, some could say that it was the beginning of their demise. They weren't able to innovate anymore. And it was just a big waste of money, because who was the biggest competitor to Microsoft to emerge? It was Google. And it had nothing to do with Microsoft's browser domination at the time. And if you look back at the oil barons and the robber barons, you know, they would have broken up. They might have broken up eventually. You can only have a monopoly if it's government enforced, in other words. That's my point.
Yeah, well, I think there's always this kind of delicate balance between this free market and taking it too far. And I think, here you say, back in the day with Microsoft and a lot of people saying, you know what, this is going to hinder innovation. But then we see something like Apple and how big that they have become, saying, you know, people pointing out to the fact that iPods are ubiquitous these days. Well, they were able to become quite successful.
I got to wrap you out here. I'm going to say the last word. We don't have free markets. If you want to weigh in on today's show, be sure to like us on Facebook at facebook.com/primeinterest. You can follow Liz at Liz Wall, and you can follow me at English PI. Liz, thank you for joining me at today's Daily Duel.
Great to duel you.
And it was a watershed day here on Prime Interest. Following a split decision at the Fed yesterday to taper or not to taper, we learned that a key Federal Reserve Governor, Elizabeth Duke, is tapering out earlier. And that trillion-dollar derivatives question was settled today, except it really wasn't. We'll have to see what tricks the JP Morgan uses to game the new rules. Think London wears squared, just like those pesky CDOs. Dr. Paul is going to doctor the media complex, while Chris Rossini breaks down the boom-bust cycle. And Bill Black broke it down in fraud terms. Turns out, control's the pivotal issue. Finally, the Apple ruling marks a turning point in tech. But watch out, because Big Brother is watching in more ways than one. Thanks for tuning in. From everyone at Prime Interest, I'm Perry Ann Boring. Have a great night.